In today's market update, we're going to be hopping around the world again and also introducing two new markets. In particular, I'm going to be discussing the idea of commonality, which is one of the principles that Hurst defined, or perhaps the right word is declared, when he published his cycles course 50 years ago. Let's start with the S&P 500. This is SPX data. This is the analysis that we've been tracking for many months, almost years now. In the S&P 500, we have our very prominent trough in October of last year, which you will know in recent market update videos we've been discussing as a trough of either 40-week magnitude or 18-month magnitude. The recent very strong bullish upwards move has encouraged the analysis to give this trough the greater weighting, as you can see, and we have an 18-month cycle trough over there in October of last year. Although strongly trending markets are great for those who are trend followers, they can be frustrating for a Hurst Cycles analyst because it can be very difficult to define where exactly in all these rather insignificant troughs that have formed, the cycles are actually exerting their influence. The important thing to remember about Hurst's approach to financial markets is that cycles do not come and go. Financial markets are influenced by these cycles all the time, and so a cycle doesn't simply disappear, but it might be overwhelmed by other cycles, which is probably what has been happening here. Following a trough of great magnitude, such as potentially this 18-month cycle trough in October of last year, it makes sense that those cycles are pushing the markets upwards with great enthusiasm and pretty much trampling the shorter cycles as they move upwards. Despite this strong upwards move, we have experienced some fairly regular cycles. For instance, this 80-day cycle that formed a trough in the first week of January had a 70-day wavelength. The average length of an 80-day cycle discovered by Hurst 50 years ago is 68 days, and if you don't understand why that is, I would encourage you to download the 10 Core Concepts document that I will provide a link to in the description below this video. The average length of a 20-week cycle, which is the next trough that we are expecting, is 136 days. You can see that over here we have had 143 days elapse since the trough in October last year, meaning that the 20-week cycle trough at the moment is about 7 days overdue. Here is the nest of lows for that 20-week cycle trough. And so what we have been expecting and what we've been discussing in recent market update videos is that price should come down and form a 20-week cycle trough. But as that trough is now approaching the point that it is in fact overdue, we have to start asking ourselves whether the very subtle trough that formed at the end of last week could possibly even be the 20-week cycle trough. I have been warning for some time that considering the bullishness in this market, we might not see a very strong move down. Answering the question as to whether the 20-week cycle trough did form at the end of last week is impossible with the amount of data that we have. But that is why we are going to be looking at other markets, and we're going to be considering what they are doing and considering whether it is possible that the 20-week cycle trough is already upon us or whether it still lies ahead of us. Here is the Nasdaq, and the Nasdaq has been easier to analyze recently because there has been much more evidence of the cycles influencing the markets, not just to move up, but also to move down into their fairly well-positioned troughs. So if we measure the wavelengths of these cycles, you can see that again we had a fairly accurate 80-day cycle playing out over 71 days. The troughs have been easier to identify in the Nasdaq. Here is a fairly obvious 40-day cycle trough. Here, of course, is the 80-day cycle trough that I think most analysts agree about. Here is the nest of lows for the 20-week cycle trough. You can see that 73 days have elapsed since the 80-day cycle trough at the beginning of January. So again, we are slightly overdue for the next 80-day cycle, which must be synchronous with the 20-week cycle trough that you can see has been playing out over 144 days since the low point in October last year. Zooming in and taking a look at what has been happening recently in the Nasdaq, you can see that price did cross down below the 20-day cycle FLD the weekend before last, and as a result it generated a target That target was at a level of 17,700. Price has not yet quite reached that target. Not entirely unusual considering the recent bullishness of the market, but we would expect for a 20-week cycle trough that price continues to go further down and will not only reach but exceed that target generated by the 20-day cycle FLD. Notice what happened last week throughout the week. Price came back up to the 20-day cycle FLD, and the FLD provided resistance. That is the power of the FLD. It is something that we see happening time and time again. The FLD provides either a crossing point, what we call an acceleration point, in which case price will generate a target to the far side of the FLD, or it will provide support or resistance. And it doesn't do these things arbitrarily at any time that it wishes. It does those things in a particular sequence. We would have labeled this price crossing down below the FLD as an F category interaction for price coming down towards the 20-week cycle trough. Having crossed below the FLD, that FLD is then expected to provide resistance as it did. So let's come back to the question of, has this 20-week cycle trough formed? Is it possible that the 20-week cycle trough formed last Friday? Again, we do not have enough data, but we will be watching the 20-day cycle FLD very closely. If the FLD continues to provide resistance, then the answer is no, that 20-week cycle trough still lies ahead of us. If, however, price crosses strongly above the 20-day cycle FLD, then we will need to accept that the 20-week cycle trough has formed, even though it is so far a fairly subtle trough in the price movement. Recently, we've also been looking at the Australian market, the ASX, and here again we can see a much clearer cycle picture. We also have an 18-month cycle trough phased at the end of October of last year. Here is the 80-day cycle trough, which came in just about 2 weeks after the 80-day cycle trough formed in the US markets, which we have phased over here. But the situation in this stock market is pretty much exactly the same, which is that we are expecting price to come down into a 20-week cycle trough. You can see that the center of this nest of lows for the Australian market is still about 2 weeks ahead of us. And so we have no reason in the Australian market to think that that 20-week cycle trough might have occurred already. However, when we are expecting a trough to form, we need to stay on our toes and watch price action fairly carefully. Let's zoom in and I'll explain why it is possible that in this market the 20-week cycle trough might indeed have formed. Here is our 80-day cycle trough in the 3rd week of January. Now take a look at the phasing of this 40-day cycle trough. It has been placed under this rather subtle price low over here. Is that a good position for it? Well, there are various complicated reasons why the trough has been positioned there by the software. A more obvious position would be over here. Let's measure the number of bars that elapsed from the middle of January to that more prominent price trough. You can see there were 27 bars over that period of time. Is it possible that the 40-day cycle trough should be placed over here? Yes, it is possible. The average length of the 40-day cycle is 34 days. And that is certainly one of the reasons why the software has positioned the price trough under this price low over here on the 22nd of February. I could influence the analysis that Sentient Trader has been performing, and I could pin the 40-day cycle trough below this price low over here, but I prefer not to do that. Part of the reason for that is because, humbling as it might be, Sentient Trader often proves to be a better analyst than I am, and so I tend to let it do its thing. But I would like to point out something interesting. If the 40-day cycle trough did form over here, that would imply that the 40-day cycle played out over 27 days. If we double that, we get a potential length for the current 80-day cycle, because we can only estimate the current wavelength of each one of these cycles at any time. So let's double that to 54 days, and you will see that brings us to this position over here. we have a fairly prominent price bar that occurred on Friday with a long shadow or a long tail below it, indicating that some kind of price reversal took place. You can see that according to this analysis, that is expected to be a 20-day cycle trough. However, we have this overshadowing 20-week cycle nest of lows, warning us of the possibility that the 20-week cycle trough could indeed have occurred. Again, how will we confirm this? Here is our F category interaction where price crossed down below the 20-day cycle FLD. It looks as if though it fairly accurately achieved that target. I'm not going to bother calculating the exact target right now, but again, at this time, we would be expecting the 20-day cycle FLD to provide resistance. It therefore becomes a very important line to watch. If price does find resistance at the level of the 20-day cycle FLD, then we know that the 20-week cycle trough still lies ahead of us. If, however, price crosses strongly above this FLD, we will need to accept that the 20-week cycle trough has probably formed. Now let's take a look at the first of the new markets I'm introducing in today's video. This is oil, and this is a very interesting market to consider. There is, of course, a correlation between oil price and stock market prices, but it is not a direct correlation. In other words, when a trough forms in the stock market, the same trough is not necessarily forming in oil. However, there is an interesting thing to observe about what has been happening in oil recently. We're going to start with the bigger picture of oil. Oil is a particularly difficult market to analyze. One of the reasons for that is because we are constantly asking ourselves, is oil influenced by cycles that are synchronized at their troughs or at their peaks? That is going to be a discussion we will have at another time. For now, we are going to focus on the trough analysis in oil. In other words, we're going to assume that oil is influenced by cycles synchronized at their troughs. Again, if you don't understand the concept of synchronized troughs, I would encourage you to download that 10 Core Concepts document. The first thing that we have to consider when looking at the price of oil is this very prominent trough that formed over here in April of 2020. In fact, the prices of some futures contracts in oil went negative at this point, which is an interesting concept, but we're not going to be discussing that here. The obvious thing to point out is that that is an important price trough. We could have a discussion about whether there were news events at the time that were causing a distortion in the cycle influence, and so potentially the actual cycle trough should be displaced a little bit before or after that, but we're not going to be complicated in today's video, and we're going to call that a 9-year cycle trough that formed in April of 2020. Since then, according to this analysis, we have had two 18-month cycles. The first one formed its trough in November of 2021, and the second one was a shorter 18-month cycle, which formed its trough in March of 2023. If we measure the wavelengths of those cycles, you can see that the first one came in fairly close to the average wavelength of an 18-month cycle discovered by Hurst 50 years ago of 546 days. It was running about 40 days late at 586 days. The next 18-month cycle, as I've already mentioned, was a fairly short one, coming in at only 16 months. But we could displace that 18-month cycle trough a little bit to the right, positioning it over here in May of last year. I haven't done that in this analysis because it does have repercussions when you move a longer cycle trough. All of the shorter cycles, of course, are also rippled forwards or backwards in time, and so moving a single cycle's trough has an influence through the entire analysis. I won't bore you with the details. The interesting point to be made about oil is that we have had one very bullish 18-month cycle. There is the M-shape, approximate M-shape that played out. That was, of course, a bullish 18-month cycle, which is what we would expect following a trough of 9-year magnitude. The next 18-month cycle was not quite so bullish, as you can see. In fact, it was a fairly neutral-shaped cycle. Again, that is what we would expect. Because there are 3 18-month cycles in each 54-month cycle, we know that the pattern is first a bullish cycle, then a less bullish or neutral shaped cycle, and then finally, of course, a bearish cycle. And that is really the important point that I wish to make, is that we are currently, according to this analysis, in a bearish 18-month cycle. And here is the next 18-month cycle trough, which is expected later this year in about August. Zooming in then on the current 18-month cycle, you can see that the 40-week cycle trough has been positioned in this analysis in the middle of December last year. Of course, in our stock markets that we've been looking at, we had a prominent either 40-week or 18-month trough in October. And so there is definitely a difference between the cycles that are influencing oil and stock markets at the moment. If we measure the number of days that elapsed from this 18-month cycle trough in March of last year up to the 40-week cycle trough that occurred in the middle of December, you can see there were 268 days. The average length of a 40-week cycle discovered by Hurst many years ago is 272 days. And so that is a good position, in my opinion, for the 40-week cycle, occurring as it does only 4 days before the average length of that cycle. But now here's the interesting thing in terms of commonality between these different markets. Oil, as you can see, is expected to form an 80-day cycle trough. There is the nest of lows. The 80-day cycle circle and whiskers is a little displaced to the left, but the shorter cycles are very neatly lined up, as you can see, over the beginning of last week. At the beginning of last week, we did, in fact, experience a trough in oil. It is very likely that that is a trough of the 80-day cycle in oil. So here is the interesting thing about commonality. Although we have different cycles that are influencing these markets, at least they are slightly out of phase, what you will often find is that when we have clear evidence of a cycle forming in one instrument, even if it is not a matching instrument, in other words, even if it is not, in fact, a stock market, but oil, as in this case, then it raises the chance that a trough in the other markets is also in the process of forming. The other new instrument that we're going to take a look at in today's market update is the FTSE. This is the market from the UK, and the FTSE is an interesting market because of the fact that we have not seen the sort of persistent bullishness that we experienced in the other markets. This is a weekly chart of the FTSE. This is the FTSE 100 index, and here is the October trough that we've been considering as a trough of either the 40-week cycle or the 18-month cycle in the US markets. In other words, that is the really prominent trough. But notice how it is not such a prominent trough in the FTSE. We do, however, have our very prominent trough in October of 2022, which is also a prominent trough in the other stock markets that we have been watching. The FTSE provides us with an interesting variation on the theme of the magnitude of the trough in October of last year. The reason why there is so much discussion around the magnitude of that trough is if we measure the number of days that elapsed from the very prominent trough in October of 2022, you can see that there were 378 days or 380 days that played out into that October trough in the FTSE. Now, the average length, as I've already mentioned, of the 40-week cycle is 272 days. And so that 40-week cycle might be better positioned over here at either this trough in July of 2023 or at this trough in August of 2023. You can see that according to this analysis, it has been positioned in August, and I will demonstrate in a moment why that is. The interesting thing about this analysis is that it warns us to expect an important trough in the FTSE later this year, in about June. And so let's zoom in and consider what has been happening as this 40-week cycle plays out. Here you can see the reason why I said that the 40-week cycle trough works well positioned in August. We had a very clear 80-day cycle that elapsed into October of last year. And then we had a fairly good, although slightly long, 20-week cycle into January of this year. Here we had a good, clean M shape for this 20-week cycle. The question, of course, is what are we expecting next? we need to bear in mind that we have a potential 18-month cycle trough looming, as you can see, in about June or early July. But let's zoom in again and compare this to the other stock markets that we've been looking at. And here you can see commonality at play, because when we zoom in from the January period and take a look at the price movement, or in particular the cycle analysis, you can see that we again have an important cycle trough that formed in January of this year. It has been phased as a trough of the 20-week cycle. Similar to the Australian market, we have a question mark around this trough over here, which played out over 27 days. 27 days is a slightly awkward number for our nominal model. Do we call that a 40-day cycle or a 20-day cycle? You can see that in this analysis, it's been phased as a 20-day cycle, and then the 40-day cycle has been positioned over here at a very long 48 days. Potentially, we need to explore other nominal models for the FTSE. However, we do have a fairly clean M shape that has played out for this 40-day cycle, and because our analysis is able to incorporate the idea of variation, in other words, it'll adjust to varying and dynamic cycle wavelengths, we can continue with this consideration of the analysis. The important message is that although price has been bouncing out of a 40-day cycle trough that formed at the beginning of March, we have an 80-day cycle trough that should occur in about the middle of April. And this cycle trough should be less bullish than this one over here, leading us to expect that we are going to have a cycle that is going to be shaped a little bit to the downside to bring us down into this 80-day cycle trough in the middle of April. I do hope you found this market update useful and interesting. If you have any questions, please put them in the comments below the video or join us on our Hurst Cycles Discord server. I look forward to hearing from you.